You wouldn't know it from mainstream media, but there's a bank here in the United States that hundreds of thousands of people trusted with their money that has now frozen everyone's accounts. But what if I told you it went even deeper than that? How a seemingly harmless app that was designed to gamify savings developed into an online gambling platform with countless ways to lose money, and that this bank wasn't even a bank at all. This is the story of Yotta, and more importantly, a call to action for the people who are anxiously waiting to see if they'll ever regain access to the money that they work so hard to save. People who have bills to pay, lives to fund, and literally everything on the line, all because they chose the wrong banking app, likely at the advice of a personal finance influencer. This is how a bank froze everyone's money. To understand how we got here, you first have to understand what Yotta was. At its humble beginnings, this was an app that was intended to gamify savings, make savings fun. They advertised the app as a no-lose lottery, and the concept was straightforward. The more money you saved in your account on the app, the more tickets you had in that week's lottery. And they were quite literally lottery tickets, numbers that needed to match that week's drawings, with a special Yotta ball to further the odds of winning grand prizes. You can probably see the similarities. But the catch was that you couldn't lose money. Even if none of your tickets drew a prize that week, you'd have just as many tickets in the next week's lottery too, as long as you didn't withdraw money from your account. Now, there were actually some really significant cash prizes on the line, at one point offering $10 million for a perfect Yotta ticket. But in reality, even those with hundreds or even thousands of tickets were typically walking away with only a few winners that earned smaller prizes. Realistically, the app functioned as an incentivized savings account with what most users experienced as a middle-of-the-road variable APY that was probably beatable by some traditional banks, but offered the thrill of playing the lottery every week without risk. And financial influencers, they took notice. Many of the personal finance YouTubers that people had come to trust advertised the platform to their viewers, and some even went a step further and invested in the company. Graham Stephan, who's extremely well-renowned in the personal finance YouTube space, went so far as to make a video saying, "I bought a bank," which, as we'll discuss later, became a real problem when people had their money frozen and then found out that Yotta isn't actually a bank. That video has since been deleted. But let's get back to the app itself. The lottery system seemed good to end users, but as it turns out, it wasn't working for Yotta. CoffeeZilla did an amazing investigative piece on this, and in his conversation with the Yotta CEO, he admitted that the savings-based business model wasn't working, so we decided to pivot. And pivot they did. All of a sudden, games started popping up on the app that were far from risk-free. Whether you wanted to put your money on a rocket ship, throw it down on a hand of blackjack, or play a game of Minesweeper, the company had made a clear decision to turn away from encouraging saving and instead started encouraging gambling. Their marketing team really leaned into this, and if you were to look at Yotta's social medias today, it'd be hard to tell that this was once a company that advertised themselves as a savings platform. Sadly, however, their rebranding has seemed to work, as new users appear much more interested in the gambling features of the platform than safely growing their money in a compounding manner. Now, morally, ethically, that's pretty objectively bad. Based on both their method of advertising through influencers and their core value of gamifying saving, the demographic on Yotta is probably a whole lot younger than your traditional bank. That makes their conversion to an online casino even worse. But if the story stopped at a fintech company being morally corrupt and trying to take advantage of risk-tolerant young adults, you probably wouldn't be hearing from me. That actually happens all the time. Unfortunately, blackjack turned out to be the least of our worries, because what happened on May 11th would change people's lives forever. If you were a Yotta user that had any amount of money in an account and you logged into the app to try to withdraw it at any point after May 11th of this year, well, it may seem impossible to believe, but your money was stuck there. Now, that doesn't make any sense. How can a bank, which was advertised as a bank, promoted by influencers as a bank, and had the user interface of a bank, simply not give people their money? Well, like I alluded to earlier, Yotta isn't an actual bank, and that's where everything fell apart. You see, you know of traditional banks like Chase or Bank of America. It's a place where you can take your money, they keep that money for you, and at any time you can come and take your money back. That all used to happen in a literal physical sense, but now the whole process is usually done online. And maybe the best part about all that is that it's safe. Even if your traditional bank were to fall on hard times and completely fail, your money is FDIC insured, meaning that the federal government would step in and make sure that you got back every penny that was owed to you when the bank failed, up to a certain amount. And that's great. If people couldn't trust that their money at the bank was protected, they'd have to hide it in their mattresses and physically protect it, which would be a really big problem for Warren Buffett. But if that's the case, then why aren't the people who haven't gotten access to their money for 4 months on Yotta being made whole? The answer is actually simple. Money isn't stored on Yotta, it's moved through it. This is where I have to introduce you to two new characters in the story, Evolve and Synapse. In relation to Yotta, the operations of these two companies were critical to everything that pertained to the movement of money. Evolve served as the traditional bank in transactions, meaning that when a user deposited funds to their account on Yotta, the money was actually being digitally transported and held by Evolve. That might sound straightforward, but financial technology companies and traditional banks don't operate the same. Because of their differences and the time and effort it takes to transact between them, Yotta and Evolve were relying on a middleman called Synapse. Think of it in the sense of trying to connect incompatible equipment to a computer, where Synapse served as an adapter that allowed both companies to form a connection without having to change the ports that came pre-installed. Well, you may have already guessed it, but the reason that Yotta users are no longer able to access their money is that unfortunately Synapse failed. They filed Chapter 11 bankruptcy and shut down their services, meaning that Evolve and Yotta had suddenly lost the connector that made them compatible. And for thousands of people who had their money on Yotta, that suddenly made their funds inaccessible. You could try to pull your money out of the app, but regardless of how much you had in your account, you couldn't withdraw a single penny. That is obviously devastating to a person. Again, this wasn't an app primarily being used by billionaires and businesses. This was the everyday American storing their money on Yotta. But you heard me say that all this happened on May 11th, and it's now September, so when are they getting their money back? Unfortunately, it's really messy. The fallout of the Synapse bankruptcy has been a disaster and started a chain of finger pointing between both Synapse and Evolve. The CEO of Synapse has been active on Twitter, claiming that Evolve is the company that has been acting shady and the reason that people haven't been made whole. Meanwhile, Evolve has remained steady, that Synapse left behind some messy accounting that revealed serious discrepancies and is making it almost impossible to actually track down whose money is whose and how to repay them correctly. With neither company willing to take the blame, of course, the legal process of the bankruptcy needs to play out before anybody can even hope to get their money back. And if things are as bad as Evolve is claiming, that could take a long time. But where's the government in all of this? Yotta customers were told that their money was FDIC insured, so shouldn't the FDIC be stepping in and getting them their money back? Well, remember what I said earlier? FDIC insurance is specifically in place for when a bank fails, and the bank in this process is Evolve, which hasn't failed. Because of that, the FDIC has no reason to step in. So maybe it's true that the money put into Yotta was technically FDIC insured, just not protected from users potentially losing access to it for, apparently, months. And what about a bailout? I'm sure people remember the banking crisis of 2023, where multiple banks stood to fail if not for the government stepping in and propping them back up. Couldn't the Fed just intervene and create a pathway for people to be made whole? Well, again, this is unfortunately very different. Many of those banks were hosting very high-value clients. Silicon Valley Bank, for example, was specifically dealing with commercial clients and startups. Because of this, the story dominated US headlines, and the government really had no choice but to intervene. Meanwhile, this might be the first time you've heard of the Yotta crisis, because instead of chip manufacturers and multimillionaires who stand to lose, it's average Americans with very little influence. So this leaves us with two really important questions. What have we learned from this, and what can we do to help the people whose lives have been entirely consumed by this nightmare? First, what we've learned: keep your banking boring. Wherever you choose to put your assets that you've worked so hard for, make sure that it's a reputable company that won't put you at risk of being in the same situation. Gamified savings is an awesome concept, and if a traditional bank was to offer a similar reward system, I think it would do really well. Just don't put your faith and money into new fintech startups. This isn't the first time we've seen that go poorly. Secondly, don't trust your money with products that are pushed by financial influencers. It may sound silly, but these people came across as experts on their topics, so it's easy to believe that the newest financial product they're pushing is as good as it sounds. But in reality, they're just as qualified to vet a company as you are, and typically they have their own monetary incentives to advertise something, so do your own research before blindly trusting them. And finally, don't gamble your savings. That one, it should be fairly obvious, but just don't. You're not going to create generational wealth at a slot machine. So now, how can we help Yotta users? Well, the absolute best thing you can do is try to spread awareness. Share videos like this one with your friends, reach out to government officials, and try to get this story circulating in the mainstream media, because it's a whole lot more likely that people will get their money back faster if the greater public finds out about this. Ultimately, this is a really bad look for banking regulation, and right now it doesn't really matter because so few people are aware of it that the regulators have nothing to worry about, and heck, maybe they aren't even fully aware of the situation themselves. But if this becomes a headline, I wouldn't be surprised at all if we suddenly saw the bankruptcy court moving a whole lot faster and people getting a whole lot more clarity on when they'll be getting their money back. Now, that brings me to something I need to confess myself, because I couldn't make this video in good faith without being totally upfront and honest about the situation. Like many others, years ago, I personally made a video about my experience with Yotta because, surprise, surprise, I was using the platform too. I had a link in the video to sign up for the app, and as an extremely small YouTuber, very few people actually used it, but some did. I no longer used Yotta by the time things fell apart, so none of my money is on the line here, but I can't say with absolute certainty that the same thing is true for anybody who watched my video video and then signed up themselves. It would be way easier to go back, delete that video, wipe any evidence of recommending the product, and move on with my life. Unfortunately, instead of raising awareness and trying to help these people, that's what a lot of the big YouTubers have opted for. But I couldn't do that. So instead, this video is my attempt at trying to help people get their money back. It's the right thing to do, and the internet needs more people trying to do the right thing. I hope you've had your eyes open to this situation. But really, more than anything, I hope this resolves itself quickly for the sake of the Yotta users. Looking through the Reddit threads reveals a lot of really hurting people, and nobody deserves to deal with something as painful as this. At the end of the day, they will get their money back, and hopefully that day comes real soon.